if there is no significant downward movement in terms of the inflation rate, they might even consider raising interest rates again. So we can reasonably expect the market to slow down. So what we typically advise our clients is to, of course, again, all the more so this year than in other years, to diversify.
Hey guys, we're gonna talk about the stock market over the next series of these videos. We have Robbi Samson from Union Bank joining us in the show. Robbi, I have something very interesting to ask. We saw the market move up at the start of the year, January 2023, and people were a bit optimistic also because we were coming from 2022 where majority of the markets, not just in the Philippines, got hit. But after that, January, somewhere around Feb, we saw it start to reverse even to where we are right now. We even went below 6,500. How do you think this year will play out? Number one, for the Philippine economy, and number two, how does that translate to the Philippine Stock Exchange Index?
What happened back in January was more of a spillover from the positive sentiment from the holiday season. So we saw the 2022 holidays were very, very good. A lot of people were going out, a lot of people were spending money. And so I guess people anticipated that fourth quarter earnings performances of companies would mostly be positive. That said, we saw how inflation remained relatively high. Essentially, up to today, it's still quite high, and so it's somewhat, forcing central banks, not just in the Philippines but also in the US, to really determine whether they should continue raising rates or not. And right now, if we can see that inflation is not really decreasing yet at a significant level, then there is the belief, there is the sentiment that the central banks might have to raise rates even more. So that's something that, of course, when you raise your rates, you're essentially trying to curb economic activity. So sales will be lower, people will stop taking out loans to expand their businesses, to open new businesses, to renovate their homes, to buy new cars, to build new houses, stuff like that. It's going to negatively impact economic activity. And so, of course, it's going to permeate all throughout the stock market. As long as inflation remains relatively higher, especially compared to the BSP's targets, we can expect that investor sentiment may follow suit. Inflation is high, prices are increasing, and then you're disincentivized from spending further because interest rates in banks are getting higher. That's all going to combine into something that's essentially going to decrease economic activity in the country.
Based on what you mentioned, it's relatively the same narrative as last year, because when we look at it, 2020, 2021, there was a lot of printing, a lot of liquidity in the market. 2022, there was quantitative tightening that sapped a lot of free money moving around, and because of that also, not a lot of free money, people become more conservative as well, and higher interest rates, of course, instead of putting it in the stock market, you could put it in bonds or in other fixed income income assets, and then you could actually make more. And that's all predicated on inflation. However, my question is this: since we had high inflation last year, would it be the narrative that because we're coming from a higher base, there's a larger chance also that because of a high base for 2023, figures should be actually lower compared to where we were last year as well?
Well, that's the general expectation. That's why it comes as a surprise anytime we see inflation remaining higher, anytime inflation goes above estimates, because we already had high inflation last year. So that means there's still a lot of money being spent by people. And if we are not able to somewhat top that, or at least make it pause for a little bit, then it might become runaway, and that's what we're trying to avoid. So that's why we're seeing central banks being very, very active. Investors are really, really monitoring what central banks are doing, how inflation is doing, because we don't want inflation to really, really get out of control, because it's going to be harder to stop at that time. They have to strike the perfect balance between, making sure there's enough economic activity, but making sure also that it doesn't get to a high enough level where it's going to really negatively impact lives of a lot of different people.
For those watching, key things to look for is inflation, because if inflation remains higher, it places more incentive also for the central bank to continually raise rates, or it wouldn't push them to bring down the rates as well. And so everything predicates on inflation and how the central bank attacks it via interest rates. My question is this though: what if in the Philippines inflation goes down, but in the US inflation remains higher? Hence, there's not a lot of movement in terms of their interest rates. Would that be would that be something people also need to look at? Because if rates are higher there, then they can't bring down the rates here, because it will affect also the US dollar versus the Philippine exchange rate, and we won't be as competitive also versus the US as well.
That's something that's going to serve as a concern for investors as well. What we just have to always remember in that sense is that when it comes to these kinds of things, there is a little bit of primacy over what happens in the US. So if there is something good happening in the US, it's going to spill over to a lot of other markets. And so if inflation remains high in the US, even if inflation starts to lower here in the Philippines, we might still see outflows from the markets, because if you're able to get good yields elsewhere compared to what you're getting here in the Philippines, and these are more developed countries, technically safer investment grades, then you can still see some funds get out of the Philippines and move back to some of these more stable places. So that's why it's going to be interesting, especially in light of what's happening in the US right now with those banks. It's going to be interesting how to see where it will fall, because there's a lot of people looking at the reopening in China, the economic resurgence in China, and a lot of people are also saying, but that's not going to matter too much if there are serious concerns over the financial sector in the US. So we can see from there, we can glean from that perspective that whatever happens in the US is still going to move markets all over the world.
So given where we are now, how do you think this will play out also? Where do you think the PSEi will end for the year as well?
Well, given the fact that for the first of the year we saw interest rates remain above inflation rate remain above 8%, then it really might cause BSP to either keep rates as high as they are right now, or if it doesn't really stop at all, if there is no significant downward movement in terms of the inflation rate, they might even consider raising interest rates again. So we can reasonably expect the market to slow down. So what we typically advise our clients is to, of course, again, all the more so this year than in other years, to diversify, because now you have options available. When you look at time deposit rates, they are competitive. When you look at bond rates, they're competitive. I think there's a mega wide preferred share or bond issuing right now that's returning about 7 to 8% per year. That's really, really good for a relatively stable company like Megawide. So that really incentivizes investors to rotate their funds from the more volatile equities into the more stable bonds, or maybe even preferred shares or time deposits. So that's going to put a lot of selling pressure. That could put some selling pressure on the market, because of course yields are getting better on other asset classes right now.
Got it. So basically, you're saying that because interest rates are higher, it's not, the market may not go as high as what people hope to be, and
Yes.
better put it into safer bets that will give you a fixed rate of return. One last question in this topic. At its current level right now, 6.5, 6.4, is the market cheap, especially for people who don't really care about what happens in the next 6 months, but they're looking at this from a 10, 15, 20-year time horizon?
It's relatively cheaper. I mean, when we look at our highs way back in 2018, 2019, we reached 7,500, 8,000. It's definitely going to look cheaper today. So if your horizon is really really long, 2 years, 3 years, then I think you're going to be happy if you invest today and look at your portfolio again 2 years, 3 years from now. However, that doesn't mean that it can't go down any further from here. So again, we're not able to predict what exactly will happen. So the best course of action is always to stagger your investments. There is no need to really time the market to really try to determine the exact bottom of the market. So usually the more prudent thing to do would be, if you have, let's say, if you have 1 million pesos to invest in the stock market today, you can really stagger it out, 50,000, 100,000 at a time, so that you'll be able to take advantage should the market go down a little bit further. And again, like I mentioned earlier, the higher interest rates support that notion. So we have to be cognizant of that reality right now.
You know what's interesting about what you said also, philosophies change also, and strategies also change. When there are times that it's so interesting to buy and look at a long-term horizon, but at some point in the middle, you also need to take profits. If you look at it from a certain perspective, if you look at it from a cyclical perspective, it corrects it. And if you don't take money off the table also during the times when it's toppish also, you will miss out also on certain moves. And those movements up, when you start to take profits, you could actually even buy more later on. Maybe unless you're buying the stock for the dividend and just holding it for the returns that the dividend would give you, the stock would give you from the dividends.